The accounting cycle. This segment's learning objective is to identify the steps in the accounting cycle and discuss the role of accounting records in an organization. The accounting cycle generally consists of 8 specific steps: journalizing or recording transactions, posting each journal entry to the appropriate ledger accounts, preparing a trial balance, making end-of-period adjustments, preparing an adjusted trial balance, preparing financial statements, journalizing and posting closing entries, and preparing an after-closing trial balance. In Session 2, we illustrated several transactions of overnight auto service that occurred during the last week in January 2018. We prepared a complete set of financial statements immediately following our discussion of these transactions. For practical purposes, businesses do not prepare new financial statements after every transaction. Rather, they accumulate the effects of individual transactions in their accounting records. Then, at regular intervals, the data in these records are used to prepare financial statements, income tax returns, and other types of reports. The sequence of accounting procedures used to record, classify, and summarize accounting information in financial reports at regular intervals is often termed the accounting cycle. The accounting cycle begins with the initial recording of business transactions and concludes with the preparation of a complete set of formal financial statements. The term cycle indicates that these procedures must be repeated continuously to enable the business to prepare new, up-to-date financial statements at reasonable intervals. The accounting cycle generally consists of 8 specific steps. In this session, we illustrate how businesses journalize or record transactions, post each journal entry to the appropriate ledger accounts, and prepare a trial balance. The remaining steps of the cycle will be addressed in Sessions 4 and 5. They include making end-of-period adjustments, preparing an adjusted trial balance, preparing financial statements, journalizing and posting closing entries, and preparing an after-closing trial balance. The cyclical process of collecting financial information and maintaining accounting records does far more than facilitate the preparation of financial statements. Managers and employees of a business frequently use the information stored in the accounting records for such purposes as establishing accountability for the assets and/or transactions under an individual's control, keeping track of routine business activities, such as the amounts of money in company bank accounts, amounts due from credit customers, or amounts owed to suppliers, obtaining detailed information about a transaction, evaluating the efficiency and performance of various departments within the organization, maintaining documentary evidence of the company's business activities. For example, tax laws require companies to maintain accounting records supporting the amounts reported in tax returns.